Welcome to Your Inheritance, your rights, your obligations, your responsibilities. With your host, Peter Bochnewich. In each episode, you'll learn insights from experts. If you're being sued over an estate or if you feel you're not getting your share, Peter's firm can help you. You can find this show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Your Inheritance, Peter Bochnewich.
We call it Your Inheritance because your inheritance is what may be at issue in your family situation. We discuss issues about family wealth and legacy on this podcast. And in these podcasts, we typically cover a broad range of issues and topics with respect to trust and estate matters, inheritance issues, and some of which may be your inheritance. And through the discussions with other attorneys and legal professionals, medical professionals, we sort through the issues that come up in these kinds of cases in court. I typically represent clients in court in contested matters in probate court over inheritance issues. So we do touch on some of those things. Nothing we discuss here today will be legal advice. If you need legal advice about a matter that's pending before you, please seek out a qualified legal professional. You can call our offices if you're in California. But we will have a good discussion that might give you some background on some things. And today we're going to be discussing, for trustees particularly, this would be very, very, very helpful. Our topic is investing for a trust fund, round 3 with Guy Kosov, a portfolio manager's perspective. A further discussion with Guy Kosov. Guy has been with us 2 times before. He's very knowledgeable about the market, about investments. We've talked before, a couple of years ago, about the advent of artificial intelligence into the management of various funds and so on and so forth, and how that may affect the economy and how that may affect investments and what trustees and people who are wealth managers might need to know about that. And so we're happy to have Guy come back again. Thanks for being here, Guy. Guy is a portfolio manager from Solas Wealth Strategies. It's a fee-based wealth and asset management firm based in San Diego. Many of his clients are looking to establish financial comfort for their children, for their children's children. And he basically takes you, I can tell you he does, takes you on the journey to make your future much more simpler and comfortable and give you peace of mind about where your investments might be. I understand the word solace, it comes from a Gaelic word meaning comfort and contentment. So that's a good name for a company. A little bit of background about Guy. He graduated with a BA in finance from Fresno Pacific University. He was very well seasoned in portfolio management. He's got a great track record of success in helping clients achieve their wealth goals. I can say firsthand that he's got a dedication to excellence and knowledge and knowing what's going on in the markets at all relevant times and not in separating the wheat from the chaff. He holds a degree in business administration, of course. He's got the prestigious CFA and CFP designations, and throughout his career, he's achieved many notable milestones as a portfolio manager and as a founding partner of Solas Wealth Strategies. Prior to all of that, he was a portfolio manager at PIMCO, focusing on fixed income portfolios. And so my first question for Guy in this tumultuous world that we're living in, but one with got a lot of excitement, maybe some tension for some people, is how is the market trending right now?
I think the market is a little bit sideways. I mean, we had a very good start for the year. You know, we had a little bit of geopolitical risk shows up like around April, and then the market bounced again to all-time highs around May. We're a little bit off the all-time high, but the market is looking good. Put it in perspective. On average, the S&P annual return, over the last 70 years, 80 years, is between 8 to 10%. So right now we're tracking around 7%, 7 to 8%. So that's a pretty good position to be in, 6 months into the year. Of course, every sector, every stock will trade differently, but the market overall holds its feet. And it seems like the AI revolution, I would call it, is really impacting asset prices overall.
And what do you mean by the AI revolution, and how is it impacting asset prices overall? And I know when we spoke in 2024, it was here, it was on the horizon more, but now it seems like it's really here and it's really taking off. What can you tell us about how it's going to impact economy and prices and so forth?
Yeah. So I mean, obviously, the main opportunity of AI is to improve productivity. When it initially came out, it was more like a smart chatbot that can do the research, at a very good accuracy level, but not the level that you will think that you will need, for a very deep and knowledgeable research to make decisions. Now we're at the level where the AI chatbot itself is on a level of a PhD in any subject. So you have at your fingertips, you have a PhD candidate or a PhD, professional within any subject that you can think about. Obviously, you need to know how to ask the questions and the right questions. But the second step that we got, and mostly of that happened in 2026, is the agentic AI. So we now can deploy agents to do tasks for us. A lot of that can be very operational. A lot of that is now implemented on the software side, on the software engineering, on the coding. We know that a lot of those companies are now not writing their code themselves. It's the AI agents that are writing the code for them, and the software engineers just supervising that and correcting if there's some mistakes. Again, it's an assisting tool. It's not something that replaces us humans yet. I will say how it impacts the economy from our perspective. When you look into the future, I think it was never easier to start a business or a startup in America right now than ever before. So, and I would say it for a few.
Right now, it's easier to start a business right now because of AI, you think?
Because of AI and because of the developments we have in AI. So I will give you an example. If 10 years ago you wanted to start a company, you had to have servers. 10, 15 years ago, you have to serve a physical server room with servers on your site, and you had to have a professional, an IT professional that manages those servers, that makes sure that everything is connecting, everything is running, that everything is being saved, that there is a backup. It was very expensive to put together a server room. Today, you have basically a replacement for the server. You have basically cloud storage on demand. So you have the three big hyperscalers, which is Amazon, Google, and Microsoft. Each one of them has some division, AWS, Azure, or the Google Cloud division. You have Oracle, and you can use them, and you pay per use. You don't even pay, say subscription. It's literally as much as you use, that will be as much as you pay for the computing power and for the most advanced, computing, and for all the storage and for all the cybersecurity protection that is associated with the data. And you don't need to have an IT person on site to manage those, which can be also very expensive. So this was in existence for, let's say, 7-8 years. Everybody's adopted that. You have some companies, very banks and stuff that have servers on site, but the majority of the companies are now have all their data on the cloud. Now with the agentic AI, you want to start a business. If in the past you needed, let's say, 10 software engineers to write code, today you might go by only having 5 and use AI to supplement the other 5. So your labor cost was cut by half. If you needed an HR system or HR personnel before, today you might use agentic AI to run your HR, to run your bi-monthly or monthly pay stubs, to manage all the back office activities. So the cost of having to establish a company in terms of labor, in terms of operational efficiency, is probably cut by more than half. What that also means that you need smaller space. You don't need as much space, less people, less space. So your real estate space also was cut by half. Now, the productivity element, you can come today from, an idea stage to a prototype probably a lot faster than what you could have done this 10 years ago because of agentic AI, because you have those tools that aid you in every step of the way and act as basically as an expert on almost every subject. So it's on you. It gives you, one perspective thing about if AI is the brain, it takes out all the heavy lifting, and you then can make the qualitative decisions and act like the nervous system that connects all the dots together and connecting the qualitative and the quantitative into one equation. So AI accelerated all that.
You've opened up a whole bunch of things I'd like to unpack with that statement, because there's a whole bunch of information in there. First of all, when we're talking about agent AI, or I guess you say agentic AI, we're talking about the AI being an agent for doing the work, I guess. They're basically the replacement for an individual that may have occupied that position before, which I guess increases efficiencies in one way, but also eliminates, we're just talking, conceptually here, eliminates jobs in another way. And there's an effect on the economy of massive efficiencies in certain businesses and certain aspects of businesses that is almost certainly going to increase profitability. And I would add to the bottom line and add to share value and all of those things. Conversely, a lot of people are nervous about it because it's eliminating people from the roles, and things of that nature. I'll pause to reflect on how it's affecting the practice of law. I mean, I don't think we can say it's going to replace lawyers per se, but boy, it has it in the last year. Even if you are embracing it, does it cut down the amount of time that it could take you to do certain tasks? I don't want to get into too much detail. This firm has made the investment. Even though we're a smaller firm, boutique firm, trust and estate litigation, it's available to us, and we can do things with it that puts us on a level, I think, of larger firms. And sometimes, if you plug in the right information, if you have the right program, it's amazing what will come out. Now, you do have to check it. You do absolutely have to check it. And there are notorious stories in the legal community about people who use it and didn't check it, and the AI hallucinated cases and just made up stuff, and they were citing the case law that didn't exist. Okay, that has happened. If you're careful about it, it won't happen, especially if the AI that you're using is in the universe of your own confined database of a case, and you're saying, I might say, prepare an outline for a deposition using these materials, give the exact information. It won't be what I'm going to use at the end, but will it give me something very quickly as a base? Yes, within seconds or minutes. And so that's really helpful. It's a tool. It's very exciting. Here's my question. If AI is taking over investment, and this is a little bit of a provocative question. I want you to be ready for it. If we've had situations where AI has hallucinated case law that doesn't exist, and where we practice and the way I know most people practice, and we're commanded by our ethics and by people have gotten in trouble for not checking, not here, but we read those stories out in the legal journals and the legal community. And you can be sanctioned for it if you're not careful, because you're citing to something that doesn't exist. Okay, so that's happened in a legal setting, and it may be because the AI goes out into the broader internet and it reads things that other people are saying about the case law, and then it combines that as if it's true, and it's taking information from a source where the guy posts something on his website that's not right, or something like that. And so that's how those mistakes might get generated. If agentic AI is doing that in investments, how do you know what data it's using to make the evaluations and things like that? I mean, if it's solid data going in, it's good because the speed of it is just incredible. But if it's not solid data going in, it could, I suppose it could create problems. Have you had discussions in the investment community about, the barriers that you have to have, or the roadblocks that you have to make sure there's checks and balances, so that if it goes off in its own direction and it's wrong, that you can catch it and correct it?
So I think this is also the differentiating factor between professionals, right? Some will use that and this will be everything they do and they make mistakes, and some will use that as a tool that enhances their knowledge and skill. I think using the right data is very important. Verifying is very important. I think that it gives you, like you said, a framework that helps you ask the right questions, that helps you research the right things, that helps you discover potential avenue or potential red flags in a certain thing. But it's not something that should form your final opinion. Your final opinion should be way more qualitative than quantitative. And qualitative, I'm saying, like, you need to be able to connect a lot of different dots to put together a recommendation or to put together a valuation or a certain company or on the economy, whatever you do. So this comes to the point, it does all the heavy lifting. So let's say right now I want to go over and analyze a company, just hypothetically a company like Microsoft. I'll open Microsoft financial statements and I'll start going through them. There are already things as a professional that you know what to look for. You as an attorney, you know the law. Me as a CFA, CFP, I know the different reporting styles. I know what can cause a red flag. I know what ratios I want to look at, like that reflect my style of investment. I know what type of growth projections I might want to include. I know how back I can go to evaluate or compare certain data. So all those things you need to know as a professional, similar as you know the law. You need to know the mechanics behind it. You can write code with AI as a software engineer, but you also need to be a software engineer to understand where AI is not really accurate, or where the AI tool data that you have is not really accurate, or where can you improve that and enhance that, or where you need to ask a few more questions to get more clarity. So it's the same thing in every profession. If you're a professional, you know your stuff. You need to have the skeleton, the knowledge, the background. What AI does is just enhances your ability. So it does, like I said, the heavy lifting. What takes you, let's say, 2 hours to organize in an Excel spreadsheet, calculate, with AI, you can do it within 10 minutes, right? You look at a 10K, which is the annual, let's say, statement for a company, and you say, pull out the income statement, export it to Excel, now calculate the growth rate that goes this, eliminate those expenses. All those things takes you seconds, and it computes and provides this data. Before that, you had to physically type in every number. That's something that AI enhances that.
Yeah.
Now, there are a lot of fields in investments. I'll give you an example. In technology is a very broad, category. You have semiconductors, you have software companies. Let's take semiconductors. It's a very technical market. It's a market, or it's a segment that is very hard to understand. I'm not an engineer. None of us here is an engineer, and there's very small details that it's hard for us to understand. But AI can help guide me of how those little things impact the company, or what is the potential outlook for profitability because of that. How does this fit into the market? What is the differentiating factor? And it's your job as an analyst, as a portfolio manager, to strip out all the noise and just get the juice of what you want to do. Sometimes it can be right. Sometimes like you said, it can hallucinate. But those models got a lot better, so the hallucination part is a lot lower than that. And you always have to keep in mind, it's basically a data aggregator, right? It uses everything that you have online to aggregate and come up with a recommendation. So you also need to know how to research and figure out, is this the correct direction? Is this the same answer I would have got if I asked the same question differently? All those little things, it's up to you. So how is it impact investment decisions? Yes, you can build a portfolio using AI. You can ask them, hey, tell me, what should I invest in? But investments is just as qualitative as much as it's quantitative. At the end of the day, there is an element of behavioral science. There's geopolitical risks. There's other risks that we don't know and don't think about. It's not a market that is moving in a status quo linear way, right? Like risks are coming and going, and there's a lot of different factors that you need to evaluate and connect the dots. And each person puts different weights on different factors that they're used for their evaluation. And each person has different time horizon, different perspective. So the qualitative element is, in my opinion, a lot more heavier than the quantitative. The quantitative gives you the direction. The qualitative is where you're going to use to make your decision. And that's based on your experience, your knowledge, and your perspective.
Yeah, I'm going to unpack that a little bit as well. And I'd just like to speak to an example of my own experience over 35 years in the practice of law, practically, just as an example of how technology has helped us. And it's not really, now AI is doing it, but I remember when you used to have to go, we all did back in the day, to validate whether a case was good law or not. And you would have books. You would have to go check the Shepherd's books. You called shepherdizing a case. There was other services, but that was the big one. And you would get these books, and you'd have to pour through books. Someone would manually put all the cases in, and you would go through the citations to see if the case that you're citing was good law or not, or if it was questioned, or if it was, God forbid, overturned or something like that. Now, the services, we have, there's LexisNexis, there's Westlaw, there's different services out there. You go, it tells you right there where it is, and you still have to read the cases and understand what's the distinguishing feature in the case. But it's taken down an enormous amount of work to check on those cases. It means that they used to teach you that in law school. I don't even know if they do that anymore, because they don't have to, probably because it's all published and it's all automated. And that wasn't really quite so much AI. It was like an earlier form of AI, which is just speed of aggregating data through computer technology, which is not really the intelligence that we're talking about now. I mean, it's not prescient or anything like, or sentient, it doesn't have that capability. So that's so useful. I can't think of anything that doesn't benefit from cutting out those kinds of things. Where it would be a question to me in investment is someone, I mean, you even see ads out there or videos or whatever's out on the internet about, hey, this is an AI based, it's totally AI. You just let the AI do it for you. I'm not comfortable with that. I wouldn't think any portfolio manager would come from that. I don't think the legal standard has risen to the level of allowing for that, for for prudent investment. If you're a trustee, you just can't let some non-human, as accurate as it may be or as helpful it may be, to take over that. It's at least not yet. And so I think that there are profound concerns for trustees in meeting their fiduciary duty and in hiring people to help them meet their fiduciary duty in making these investments, not to just trip it off to an AI program that says, look, this is better than humans. You don't even have to worry about anything. It's going to do everything for you, right? I mean, because you don't know. And then it helps you on the quantitative side of collecting all the numbers and crunching all the numbers. But then the quantitative side that you're talking about is, well, what does that mean to me as a person? I mean, how do I want to live my life? What is my comfort level for any of these things? That seems to me to always going to be human to human contact. I would hope.
agree with you. I think the emotional element, right? Like every client is different. Every client has different circumstances. Every client has different goals. Every client comes from a different background. Learning the individual as an advisor, you're again, there's different categories. There's categories that fit into the mass tool, right? And maybe that happens earlier in an early stage in life where you're still working, you don't have time, you don't have enough capital. But I think once you start accumulating wealth, your goal, as Peter Bochnewich will be very different from my goal as Guy Kosov, right? We have two different goals, or a lot of different goals, but right, and we have different risk tolerance, and we have different ability or willingness in terms of risk tolerance. So those are all play a factor. I don't think that a machine can understand that from writing something. I don't think this is something that you can quantify. Like, yes, we have all those psychological models to quantify, risk and everything, but the fact that me and you getting, let's say a score of 5 doesn't mean that we have the same risk tolerance. Doesn't mean that we should have the same type of portfolio, because there's other factors that play into that. There is a time horizon. There is goals. You might be 80 years old, but you don't care about the portfolio. The portfolio is meant for the next generation. You might be there's a taxation element that plays a key role there when you think about portfolio construction. There is a lot of different factors. You also don't know people's real tolerance to take risk until you see them, how they behave in a correction or in a bear market, because then is when you fully understand how people feel when there are losses or where the portfolio is declining. So I don't think a machine can learn that. And I don't think this will ever replace the high net worth or the person that is looking for the more tailored and the more long-term type wealth accumulation. I think the main point is everybody that tries to say, when you're trying to save money and use those tools, a lot of times you don't end up saving money. You end up using tools that are very generalized, they're not appropriate to you. So when a person goes and invests or using an advisor, they need to understand it's a marathon, it's a long-term journey. And at the end of the day, the cost is not measured by one action or 1 year. The cost should be measured, the cost of hiring services versus what you're getting back should be measured over a period of 3 to 5 years to really understand the full value that an advisor gives you. And that's the perspective I think that people have to see. So AI is an enhancer. Your advisor uses an AI for sure. You're using AI for your tasks at work. It's the same thing.
Right. What do you think the overall impact, if you have an opinion, or if you can say, because you're a market analyst, and so we know, like right now we're talking about how AI is used as a tool in what you do, and I'm reflecting about how it's a tool in what I do, and engineers might say, well, it's a tool in what we do too, because we can, if we have to do calculations on stresses and various things in civil engineering, hopefully the data is right. It's going to give us better answers than it would have been back when we used a slide rule or when we went to computers. So all of those things are enhancements. But what do you think the overall impact, if you can say, as a market analyst, on the growth of the economy and employment and everything that AI is going to do? And I say that with this. Understanding. It's here. It's going to happen. There's no going back. If we think it's a genie, the genie's out of the bottle. I actually think it could be looked at, as long as we contain it and make it safe. It's a profound blessing upon it could really be something that's used to create greater opportunities and make greater wealth for a great equalizer of improve the quality of life of everyone down across the globe. It has that potential, seems to me. What's the effect going to be on companies and bottom lines and jobs, and what do you think?
So I think there's a lot of fear. Let's start with the employment. Well, this is a very big, and complex question. So we'll slice it part by part. So let's start with the labor market. There is a lot of fear that AI will displace a lot of people, and a lot of people will find themselves without a job. So far, we see zero evidence for that. So far, the unemployment rate is holding up pretty steady, still below all-time, historical averages. It's not at the same level that we saw maybe, 2 years ago, which were unsustainable, but it's still below. I think it's also a little bit of an equalizer to the fact that we have some limits on immigration right now. So, it provides some type of balance. There is also fear that, agentic AI, for example, is going to take a lot of tasks. This fear was around also when computers were introduced, right? This fear was around when railroads were introduced. This fear was around when I would say every technological innovation that we had in our lifetime or in our world, this fear existed. The reality, I think, that was one of the major banks did a research that the number of jobs after every technological innovation did not decrease, but the opposite actually increased beyond what it was before. The number of jobs, the jobs that are offered to people, and the impact to the labor market was actually always positive. So I think it'll be the same case here. We still don't know what type of new jobs AI will create. We know that from a perspective of the great equalizer, today the highest demand jobs are probably like the blue collar jobs, the electricians, the plumbers, the construction workers, because to build the data centers, you will need all three of them, a lot more of that. So all those little things are, at the end of the day, creating a little bit more an equal opportunity, equal environment. And it's not just the white collar jobs that we're talking about, the service, the office jobs that are benefiting. So I think the job market is going to surprise a lot of people and going to stay very healthy. And we also have to understand that the technology sector in terms of jobs is very minimal part of the overall job market. So when you hear about layoffs in technology, put it into perspective, we also had a lot of hiring that happened in the last 3 years. And we probably have a lot of overhiring that we're trying to balance out. So that's part of it. But I think the potential of new jobs being created, the potential of within organizations, new jobs being created is magnificent and like nothing we've seen before. And like I said, the opportunity to start companies on your own. If you want to start today a retail business and you don't know how to put together a website or you don't know how to put together a logo, you can use AI to do that. And if you don't know how to put together an ad online, there is tools today that you can use to do that. And those tools are more efficient and you're able to hit your targets better. So you have opportunities to start a business and you have opportunities to find places where you can add value to your organization by using those tools as well.
Yeah, it seems to me that anything that comes along that has a tendency to make something more efficient is going to be better. The question is, if someone's number crunching in an office like Bob Cratchit and the Dickens novel, The Christmas Story, or whatever, and you're working, laboring at night with pen quill and stuff. I mean, we've moved from that era. Now you have computers to do everything, and you gave the analysis that every time we've had a technological innovation, it's increased the ability. It's expanded the job market. So you might have an elimination of one kind of job, but you'll have the advent of another kind of job, and you'll also have the opportunity created by being able to do things that a smaller entity can do or an individual can do that only a larger entity could do before. And that almost seems like it's potentially limitless with the
Right.
opportunity it can create. and the companies that can come from that and start and go public and do all of these different things. So, I mean, there's probably going to be a transition period, and there'll be, I guess, what they call the word they use is disruption. But I don't know if the disruption is necessarily going to be quite as big as they say. I hope that it's not. The fact of the matter is, it's coming, and it's here, and you got to embrace it. You hop on board, or I don't want to say hop on board or be left behind, but because I do think it's going to help everybody. But it's here. It's showing up in everything at a really rapid pace. Have you found that it changes basic investment decisions that you say you might make? Does it change or just help? I mean, the basic decisions that you might make for an 85-year-old person who wants to live in their own home and has to manage a retirement. I mean, what does it matter? It doesn't. That doesn't change their physical circumstances. It doesn't change. It just maybe gives you what does it do to help you there?
So I think, and I think this is probably more towards the portfolio construction element that you're talking about.
Sure.
An 85-year-old individual, and we'll take the basic case, right? Like, it's someone that the time horizon is not very long, not a long life left. So I guess the level of wealth is very important. Also, the dynamics of what kind of assets are you managing? Are you managing? Is the majority of the income, or the majority of the person's assets are in their residence or real estate portfolio, or is it coming from their retirement accounts that you had? So all those things play a factor when you make those decisions. I think that you cannot get away today in this day and age with having 100% bond portfolio or fixed income. Fixed income is basically just the same thing as it's an inverse name to bonds, so I think you cannot get away with being 100% invested only in bonds these days. You have to have some element of equities in your portfolio. How is your exposure to AI within those equities? I mean, today it's almost through every sector. It's already touching every sector. I'll give you an example. Let's talk about.
If I may interject, when you say you can't, traditionally someone might be in very conservative investments and be in the bond market or whatever for a person who's reached a mature age. That has to be balanced against the fact that people live very long time. People live very thriving lives well into their elder years. Got plenty of people who are active. Certainly, the 70s is nothing anymore. It's just like you're youthful, and they're very active, and you could be an octogenarian and still be active. So you need you want to make your funds last, and you also might want to grow your funds for if you believe in, if you have a philosophy of creating a legacy for your children and things of that nature. So if you just restrict it to super conservative investments that have a yield, a very solid but possibly low rate of return, you're not growing it and keeping up with inflation. So you're saying maybe 15 years ago that might have been a trend, and that would have been a way that you would have said, we're going to put everything in conservative CDs and things of that nature or whatever for older people. But you're saying, no, you still got to have some equities in there, and you still got to be having some growth, because you've got to grow it. You got to make sure it lasts through your whole life.
Right. And I would not even say 15. I think like pre-2000, we're talking 90s, 80s, that might be the perspective of how you can, maintain your purchasing power, grow your wealth. We had a big regime change from a monetary standpoint after the financial crisis. For the first time in history in 2008, we saw rates dropping to zero. So at that point, the holding bonds in your portfolio or buying new bonds to your portfolio made 0 cents, right? You're getting zero return, or you're getting 1% return. on a 10-year treasury or 2% return on a 10-year treasury. That's not enough, obviously, to keep with inflation in the long run. So I think that's where things started to shift. I think that's where equities became a necessity in a portfolio. And it doesn't mean just, you're going from 0 to 100 either way.
Right.
You can have a certain structure where the person gets a certain income to maintain their lifestyle while also adding in the portfolio to grow the portfolio, based on their needs, based on the circumstances, based on the type of account, if it's a retirement or taxable account, or if it's an irrevocable trust, whatever it is, all those things being taken into consideration. But that came, to be, and I would say even from 2010 to 2020, the innovation that we had from a technological standpoint is tremendous. I mean, we went to using our cell phone for everything. It's like a little computer that we're walking around with. If it's the GPS that became more accurate, if it's the fact that it tracks our steps and gives us health information, or if it's the fact that we have all those applications that we can use to do our banking, within our fingertips and send money within seconds. So even that was an innovative cycle that we've been through. Now with AI, it's way broader, way bigger. It touches everything. And I think it's just something that we haven't seen before, because we're going to see companies are moving from, let's say we'll take a very basic example, a company that is in the retail space. A company in the retail space, in the past, you have all those logistical models, all those logistical innovations to be able to match what you're ordering to what is selling the best, or, in order to basically maximize your profit and your shelf life. But it was never perfect. It was okay system. With AI, you can literally figure out, predict, or make the best decision of what to order, when to order, for your clients, for your customers, in such an efficient way that you can match them up to 95% and above already where we are right now.
You don't even have to have inventory necessarily. I mean, or you can. I mean, you could almost. It's almost like you could predict. It's like someone places an order, and it's like you've got the prediction as to when you should start making it to meet the order within the days that you have, or where it is in the timeline, or where it is in the
Right.
timeline of production. And I will say that I mean, if you look at retail, I mean, if you look at what the jobs that used to be in retail, I mean, it used to be that everything's changed. It used to be that you had a mechanical person at the cash register to ring you up and change the money and stuff. And now it's changed to scanners, and you do it yourself, and you put your card in, and you're not using physical money at all. And that hasn't shrunk retail. It hasn't shrunk
expensive.
It's blown it up enormously. So if we might see that trend. There are some very famous people out there who predict that AI will create, ultimately, AI with AI-driven robotics and so forth, a world of abundance and so many goods that we might actually have a period where things deflate,
Right.
where it gets cheaper. So what do you think the outlook is for inflation in the near term, and the advent of AI as correcting that or reversing that?
So I think the outlook for inflation in the near term is we're going to see some decline in the numbers, especially in the headline numbers, which include energy and food costs in the upcoming months, right? The war with Iran created an oil shortage, which we saw oil going to an average price of close to $100, and a little bit above at some points. Oil is back to levels that, lower than what we had before the war. We're at $72, $73 a barrel right now. So this is definitely deflationary from the headline number. The core inflation number, it'll take a little bit longer. There's other elements that play a key role. Talking about AI, memory chips today are very expensive. There is not enough. This demand outpaces supply by a few years forward. That means that your iPhone is probably going to cost a little bit more because the components that goes into the iPhone are more expensive. If it's the chips or if it's the plastic or if it's the whatever it is, right? All those little things. So I think core will take a little bit longer, but I think things will stabilize. Inflation is important in the long run. And I know the Fed, and it's always been talked, the Fed has this 2% target rate for inflation in order to keep the economy in neutral, not overheating, not cooling too much. This is based on all economics, textbook theories. In reality, the world deviates a little bit from that. Inflation is not a problem as long as it's stable, as long as companies can plan ahead. So if inflation is at 3%, but we think as a company that for the next year is going to be at 3%, then we can factor our price increases for our products based on a 3% inflation. And that's the most important part. Now, if inflation is 3% and it suddenly middle of the year jumps to 6%, then we have an issue because our prices are not enough to cover our costs to manufacture those goods. So that's when it becomes an issue. Vice versa, if suddenly inflation drops to 1%, then we are charging a little bit too much. But then that also can be a sign that demand is slowing down because, inflation is slowing down. Not a lot of people are buying those raw goods, and at some point it will trickle down to us. So inflation needs to be stable. It doesn't mean that a 2% is the gold standard, and it doesn't mean that a 4% is bad. It all depends on the economic growth that you produce, and it all depends on the stability of the rates and people's ability to plan forward. A lot of things tied in the mainstream media, to the real estate market. Obviously, rates are higher now, so it makes it more expensive. But, again, look at the 90s. Relative to the 90s, those are not really high rates. Look at 2015. Those rates are not a lot higher from the rates that we saw in, 15 or 17 or 2018 even, those some mortgage rates of 5.5%.
Oh, go back further. I mean, if you go back further into the 80s or the, early 80s, I mean, you were lucky to get a mortgage at 9% or 11%, or there was very much higher. I mean, it was, the costs of the homes were different and so forth.
Right. So it's the cost of ownership that changed. Yeah. And the cost of ownership is more driven by this factor that demand, again, outpaces supply. We're not building enough. So maybe AI, and we already have companies like Lennar and a few other big builders that are using those machines to build homes. And those homes are the shell of the home is being built within a couple of days instead of weeks. So we already see it start coming there. But there needs to be also some regulatory changes that we need to implement, right? Like the bureaucracy of getting permits and everything around that. But the problem is supply is way too low relative to demand.
Right. So, I mean, trying not to get too political here, but I understand there was a bipartisan bill that recently just passed to try to increase building and get, which I think is very important, create a greater abundance of stock of homes in that first time buyer able to get in, maybe not eliminate the entirety from the market of corporate groups buying up single family homes and renting them out. I mean, but that creates a problem because that's a policy thing more than anything else, because that's effectively a restriction on supply. But if you have a policy that says, no, look, we want a country that, we didn't want to get political, but we're getting a little political, but if we want a country where young people can buy homes, raise families in their homes and own them and build wealth for themselves and have that stake, then you have policies that say, look, that's what we're going to do. We're going to give incentives to create that supply. It might affect equity of other people's homes, bringing some of that wealth down in the home you live in. Maybe not. But I think it gets people into the market and owning a home and and building equity, which we have a dearth of right now because younger people can't do that. And we've done it before. After World War II, we've done it. You had these neighborhoods that went up in various parts of, New York, wherever. It's where people would get homes on the from various GI benefits or whatever, and you'd have vast tracts of what you might call starter homes, but what you could live in your whole life, or you could trade up later on if you wanted to, and that kind of thing is policy based. And doesn't have so much to do with AI, but what you're telling me is that AI is basically an inflation reducer potentially.
Yes, potentially, yes.
Because because it can do things faster and create things
more efficiently.
So it will, if you're enabled to introduce more products to the market efficiently, then the prices are going to go down.
That's and that ties into the economy, right? It's going to enhance productivity because you do things more efficiently, you're more productive. You're doing, to put it simple, you're doing more with the same amount of inputs that you have. So you work same 8 hours, but you're doing a lot more within those 8 hours than you did before. So from an inflation standpoint, I believe that will stabilize. I think we'll see the next few months, we'll see inflation, coming down probably below 3%. Where we are right now is 3.4 based on the latest reading of the core PCE. So I think the core will come down under 3%, and we'll see it keep trending down. I think the Federal Reserve will reverse its more hawkish stance now. We also had a change in the Federal Reserve now, right? So it will reserve its more hawkish stance, and we'll see a little softening there, and we'll see rates being cut again, and we'll see rates being stabilized in the long run. The economy is in a great position in terms of growth, and the economy is actually doing relatively well. The first quarter, we had 2.5% GDP growth. Today, yesterday, we had revisions to the initial numbers from 1.6, they increased it to 2.5. That was the final reading, the second reading. So 2.5% is not bad for a very mature economy, and it's definitely outpacing the rest of the world. So you also need to look in relative terms, what is happening in other countries. I mean, we are growing a lot faster than the other developed world. Of course, China, people will always bring it up, but again, those numbers can always be scrutinized. It's whatever you get can always be questioned. So we're focusing on what we can focus on. So this is an element, I think, that is always being overlooked, that relative to other countries, we're growing very robustly. And the innovation we're bringing to this world is very significant. And everybody relying on our innovation, here as a country, the rest of the world, and that innovation will pay off. And I think this is just the first steps because we're in the investment state. We know we don't have enough compute. We don't have enough power. We know we need all that just to start. Because of that, we cannot produce enough semiconductors in different aspects of the AI to enhance those models. And because of those, we have some limitations on our plate. Companies are still trying to figure out the business model that is appropriate. Again, this is an innovation. We don't have benchmarks to measure, return on investment because we never had an investment like that. We never had a cycle like that. So companies are still trying to figure it out. But I think you already see as individuals, and me and you, we can say that personally, we see an enhancement to the work that we do. And that's an actual return on investment when you think about it. Because I'm ready to spend for the premium models because I see what it does for me, and same for you. And even if they raise it by $10, I probably will still pay for that because the benefit that I'm getting from that is way greater than those extra $10 that I'll spend every month for them.
Couple of questions as we coming to a close here soon. For the economy to go forward in a positive way, a couple of questions. Do you think that the market will continue to be able to grow at that 7 to 8% rate over the next, say, 5 to 10 years? Question number one. And number two, to facilitate that, what do we need to do in terms of core investments in key industries? Like, we have to have more electric power, for sure. We just do.
Right.
If we're going to keep up with compute, all these things to create, it all runs on electricity. And then there's all kinds of things that we have to think about where is that going to come from? Is it going to be clean? Or do we rethink about nuclear and all that kind of stuff? Now we get into political discussion a little bit, but that seems to be a core element. We got to have build out the electric grid. We've got to get a handle on how data centers are going to impact the environment, but we have to have them. So we got to balance that, right? And chip making has to be. We got to onshore it. I mean, in a big way. I mean, you would wonder why we wouldn't just. I mean, it's astonishing to me that so much of the chips are made in one very innovative place, right?
Yeah. Well, that's economies of scale. It's cheaper to produce them there, so it was all going there. But we see a lot of ramp up in investment in chip factories in the U.S. Look, one of the three biggest memory chip makers, Micron, is a U.S. company. The other two are Koreans, right? So this is a big. They building a lot. Taiwan Semis, which is a Taiwanese company, is building in the U.S. as well. Fabrication facilities. Intel is. I think the government took a stake in Intel. It became quasi whatever, like a government-backed like a company. But it's important for the security of the U.S. to have a fabrication company that is a U.S. made and operates in the U.S. So that's a step there from a geopolitical standpoint.
Sure.
And that's not being political. That's something that is agreed by everybody. That's just like a security thing. The same way as you have. I think in military, the same way you want to make sure that your business is not being disrupted. We learned from COVID that when business is being disrupted, it's not really good. And even now with the war, we learned when things are being disrupted, it impacts everything. What needs to be? So those are the steps that obviously needs to be taken and are already being taken. I think in terms of electrification and power, I mean, there is no doubt that we need everything. There is no doubt. We just don't have enough. We need to figure it out, and we need to make it. There's already alternative solutions that are being worked in place. I think we have great innovative companies within the U.S. that are doing a great job there. And I think energy storage is probably an element that will be figured out. Working with the local communities to build those data centers. They're not always bad. They actually might even have a positive, or probably will have a positive impact on the economy. I mean, it's the same thing if you going like to the 1900s or 1950s and electric plants were being built. You would, let's say you live in a village or in a small town where there's no electricity, there's no active electricity, and you're using fire or propane, whatever, to light your candles. And you don't know how electricity is going to transform your life. But once it's being introduced, you understand that. So the same thing. There's so obviously there's need to be work with the local communities for that.
I think that lowering the cost of electricity. I mean, you've got to make it so it's sustainable for the companies that are providing it. But lowering the cost of electricity, our ultimate goal is to go as clean as possible with electric power. We need we need electric power because the only power that funds compute is electric power. So we have to have a great increase in electric power. And so if we do that, we know we're already going to be required to build the infrastructure that makes electricity more abundant. So if we have electricity more abundant, just think if you can get that kilowatt hour price down to run your car, run your house, heat your home, cool your home, whatever you got to do, run your business, run your business that's going to be run electronically for the most part anyway. If you bring that cost down, it will be an amazing. It will be like the age of taking people from living without electrification into electrification. Now, some people might say, "Well, I'd rather go back in the day where you worked during the sun came up and you went to bed at night, and that was a more wholesome, holistic environment. But, if you think about if there's one thing that will drive prosperity and quality of life, it's abundant, clean electric power, as clean as we could possibly get it, and then use the technologies to get us to that clean spot. I mean, we might have to have some interim, we can't overlook nuclear power. I'm going to say it. We should be doing it. We have to have it. I think we've come a long way. Well, we won't be able to keep up with the demand for it if we don't kind of have an all of the above approach. I mean, I don't know that we necessarily have to revert to coal or anything like that, but if there's technologies that can capture the carbon and all that kind of stuff, that's one thing. But there's no question about the fact that if we're going to keep up with, if we're going to be competitive, we have to have it,
Right.
more power.
Yeah, and look, this is all happening, and this is all in development. It's not a 1 month solution. This is a long-term process. This is a marathon, and I think we're at the beginning innings of that. And thinking about the market and how the market is going to navigate, and you're asking me if the market can sustain this 8 to 10% going into the future, and I think yes, absolutely. But people need to understand, when you're dealing with investments, it's not a linear growth. It's a bumpy growth. It's a bumpy growth, and it's what plays a key there is the time horizon. So you can have great few years, and then you can have a year where you're having a bear market, and that's good because the market is flushing out all the inefficient capital out of that and rebooting the system in a way, and then capital start flowing back again into the market. That's part of the game. But I think betting against the U.S. and the innovation that we have here and U.S. equities is something that you should not be doing. And again, it's a time horizon question. You should not go into equities if you're looking to invest for a year or two. You should go into equities if you're looking to invest for 10 years. So that's the perspective. And yes, I think 8 to 10% is very realistic given the gains that we'll see in productivity. 8 to 10% is very realistic given the potential that AI can bring to us as a society. So I think that, again, we're in a great spot. I don't know what's going to happen tomorrow. I don't know what's going to happen in a month from now. I don't know if the market is going to drop 10, 15%. But I think that 10 years from now, we'll be sitting here and saying, wow, what a run we had for the last 10 years. It's very similar to what we had from 2010 to 2020. I think that people tend to focus on the 2000 to 2010 as a lost decade, that the market haven't done anything really. But, it's putting into perspective as well. It's, again, we had two major corrections. One was a 3-year correction when you think about the tech bubble that we had in the early 2000s. And the other one, we had the financial crisis, which was just bad policy. And I think lessons were learned. We'll have more of those type of mistakes in the future because that's just the nature of the world. But I think that we will not see a lost decade for the next 10 years. I don't think that's going to be.
It seems to me, and I don't know if this is just a hypothesis. When people can't, you can't fear corrections. No one wants to be in a correction, and you don't want to retire in the middle of a correction, or you don't want to say, "Oh, I'm ready to go it now," and all of a sudden I've been corrected out of what I just wanted to do in the next few years. But corrections are just that. They're corrections. It's a necessary thing to happen to put you on the correct path. And I think that what's going to happen seems to me that the speed of that is just going to accelerate. So what might have been a 3-year correction or a multi-year correction, and you have to wait it out while everybody gets back into it, it's going to get compressed. That's why you see such volatility. It's happening so fast because people's ability with all these tools to react is so fast. And so companies, something bad happens, they can kind of fix it quicker too. You know?
They can fix it quicker. The communication is better. The ability to react is way faster. And I think there is also a mental change that is happening. We're facing the biggest wealth transition in history, right? So a lot of people are going to inherit a lot of money, already inheriting a lot of money. And with that money, they were trained differently. They were trained to think about the equity market as the place to invest, because they grew up through an era where the bond market paid you almost nothing. And the bond market did not allow you to accumulate wealth. So the relationship between investing in equities versus bonds changed also fundamentally. And I think this is also something that we need to understand and think about it from a societal perspective.
Guy, it's been a great conversation. It was a long conversation. It was probably more open-ended than some of our previous conversations, but that's kind of where we're at right now with this.
Yeah.
I mean, I just think it's exciting times. I think young people should be enthusiastic about the future. I think we're on the verge of some things that there's going to be some scary times. We've always had scary times.
Right.
We've had really scary times in the past. They're way more scary than they are now, right? Way more,
right,
in some ways. But we have this, the information age that we have gives us, the common person has more power than and information at their fingertips than kings did in years ago. And I think there's every good cause to be enthusiastic, and there's every good cause to be enthusiastic about what we do right here in America and the American economy and the stock market and the equities market. And I want to thank you for sharing your thoughts with us today. And we'll have you back again. And thanks for your insights.
Thank you, Peter.
You've been tuning in to Your Inheritance, your rights, your obligations, your responsibilities, with your host, Peter Bochnewich. If you're being sued over an estate, or if you feel you're not getting your share, Peter's firm can help you. You can find the show at www.betrustlaw.com and on YouTube, Facebook, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive feedback, comments, questions, and for sharing the show with others.